The market is currently closed for the weekend. As of the last trading session on Friday, SoFi Technologies Inc. closed at exactly $27.62, representing a sharp intraday decline of 6.69% or $1.98 per share. When you see a stock like SoFi take a nearly 7% haircut in a single session, the immediate knee-jerk reaction from the retail gallery is almost always panic. The red numbers on the screen trigger a fight-or-flight response, and the prevailing narrative instantly shifts to something is broken or the run is over. You look at the charts, you see the gap down from the previous close of around $29.60, and you assume the smart money is fleeing the building. That is the expectation. It is the easy, comfortable story that fits a bearish bias. But the reality of what is happening with SoFi right now is significantly more nuanced and, frankly, demonstrates a level of strategic aggression that most competitors in the fintech space are too afraid to execute. The drop we are witnessing isn't a sign of operational failure or a broken business model. It is a calculated cost of capitalization. SoFi announced a massive $1.5 billion public offering of common stock, and while the market hates dilution in the short term, this is a textbook example of raising capital from a position of strength rather than desperation. Most companies issue shares when they are running out of cash and their stock is in the gutter. SoFi is doing the exact opposite. They are tapping the markets after a massive year-to-date rally where the stock is appreciated significantly, meaning they can raise $1.5 billion with significantly less dilution to existing shareholders than if they had tried this a year ago when the stock was languishing in the single digits. This is not a distress signal, it is a war chest being filled. Let's look at the price action in detail, because the way this stock traded during the last session tells us a lot about who is selling and who is buying. The stock opened at $27.37, already gapping down significantly from the prior close, and traded in a range between $26.93 and $27.93 throughout the day. The volume was immense, clocking in at nearly 100 million shares traded, which is substantially higher than its average daily volume of around 61 million. When you see volume spike like that on a down day, it indicates a transfer of ownership. The weak hands, the traders who bought in at $28 or $29 hoping for a quick flip, are getting washed out by the news of the offering. They see dilution and they hit the sell button. But on the other side of those trades are institutions and long-term accumulators who understand that a $1.5 billion cash injection gives SoFi the firepower to weather a higher-for-longer interest rate environment, or more interestingly, to pursue acquisitions that could further entrench their moat. Unlike Tesla stock, which often trades on pure sentiment and Elon Musk's latest tweet, or Apple stock, which trades on global supply chain flows, SoFi trades on the credibility of its bank charter and its ability to scale. The market is pricing in the short-term pain of more shares hitting the float, but it is largely ignoring the long-term gain of a fortified balance sheet. You have to contextualize this move against the broader fintech landscape. If you look at Robinhood stock trading patterns or the way Interactive Brokers manages its capital, you see that the most successful financial platforms are the ones that never let a crisis go to waste. SoFi is positioning itself to be the predator, not the prey. The $1.5 billion raise is likely going to be used for general corporate purposes, which is the standard legal boilerplate, but in the hands of CEO Anthony Noto, general corporate purposes usually means aggressive expansion. This could mean expanding their lending capacity at a time when other banks are pulling back, or it could mean doubling down on their technology platform. The expectation is that this money will just sit there or be used to plug holes. The reality is that SoFi has just handed itself a massive runway to outlast competitors who are struggling with liquidity. We need to talk about the psychology of the investor here. When you use investing sites or manage your own money through self-investing, it is easy to get caught up in the daily noise. You see a headline about a stock offering and you assume the company is in trouble. But consider the timing. SoFi shares have been on a tear, rallying significantly over the last year. Management is effectively saying, our stock is valuable right now, so let's exchange some of that paper value for cold hard cash. This is the same strategy that allowed major tech giants to build their empires. It's smart management. If they waited until a recession hit and the stock dropped to $10 to raise this money, the dilution would be catastrophic. Doing it now, at $27, is efficient. It stings for a day or two, perhaps a week, but it secures the future. This is the difference between thinking like a day trader and thinking like an owner. A day trader sees a 6% loss. An owner sees a company that just secured its survival and growth capital for the next 3 years. Now, let's pull back and look at the actual business because the price movement is meaningless without the fundamentals. SoFi is not just a bank. It is a three-headed monster consisting of its lending arm, its technology platform, Galileo and Technisys, and its financial services segment. The lending arm is the cash cow, generating interest income from student loans, personal loans, and mortgages. This segment benefits when interest rates are high, as they have been, because SoFi can charge more for loans. However, the real secret sauce that the market often undervalues is the technology platform. Through Galileo, SoFi powers the infrastructure for many of its competitors. When you use other online investment apps or neobanks, there is a decent chance that the back-end processing is actually running on SoFi's rails. This makes SoFi an infrastructure play, similar to how Amazon Web Services is the backbone of the internet. They are selling the shovels in the fintech gold rush. The third head, financial services, include SoFi Invest, SoFi Money, and their credit card products. This is where the growth is explosive. This segment is all about the financial super app strategy, getting a user to join for a student loan, then stay for the high-yield savings account, and eventually use the SoFi investing tools to buy stocks and ETFs. Comment below how many shares of SoFi you currently hold and what your average cost basis is. Are you green on this position, or are you waiting for a recovery? This super app model is what differentiates them from a legacy player like Fidelity. Fidelity Investments and Fidelity Wealth Management are incredible businesses, but they are built on a legacy chassis. They are trying to modernize, sure, with the Fidelity mobile app and Fidelity trading platform, but SoFi was born in the mobile era. Its cost of customer acquisition is dropping because of the flywheel effect. Once they get you in the door, they cross-sell you aggressively. You might sign up for the checking account to get a high APY, and suddenly you are being offered SoFi Active Investing or their robo-advisor services. It's seamless. Compare this to Schwab Intelligent Portfolios, which is a great product, but exists within a much older, more fragmented ecosystem. SoFi's entire architecture is designed to reduce friction. This is why the user base keeps growing quarter after quarter, regardless of what the stock price does on a random Friday. The user growth is the leading indicator. The stock price is the lagging indicator. The bear case for SoFi, and the reason why the stock has 23% sell ratings from analysts, usually revolves around the risks of the loan portfolio. Skeptics argue that if the economy enters a hard recession, defaults on personal loans will skyrocket, and SoFi will be left holding the bag. They also worry about the accounting treatment of these loans, and whether SoFi is marking them to market accurately. These are valid concerns. If employment spikes, people stop paying their loans. That's a fact. However, SoFi's borrower profile is not the average American. Their customers tend to have high FICO scores and high incomes, often referred to as Henrys, high earners not rich yet. This demographic is far more resilient to economic downturns than the subprime borrowers that other fintechs target. Furthermore, holding a bank charter gives SoFi access to lower cost of capital, deposits, compared to non-bank lenders who have to borrow money from Wall Street to lend it out. This charter is a massive competitive advantage that Robinhood Crypto or Robinhood Cash Management products simply do not have the same leverage over. Let's verify the valuation perspective. At $27.62, the stock is trading at a premium compared to traditional banks, but a discount compared to high-growth tech stocks. The market is struggling to categorize it. Is it a bank? If so, it's expensive. Is it a tech company? If so, it's cheap. The reality is that it's a hybrid, and hybrids are notoriously volatile because Wall Street algorithms don't know which box to put them in. When Nvidia stock moves, it moves based on chip demand and AI capability. When SoFi moves, it moves based on interest rate curves and user growth metrics. It's fighting a war on two fronts. The recent $1.5 billion raise adds another layer of complexity. It dilutes the earnings per share in the immediate term, which is why the PE ratio effectively gets more expensive overnight. But if that capital is deployed to generate a return on equity, ROE, higher than the cost of capital, the intrinsic value of the business goes up. The comparison to Interactive Brokers trading is also instructive here. Interactive Brokers account holders are typically sophisticated active traders who care about execution speed and low margin rates. SoFi is targeting a different demographic, the set-it-and-forget-it investor, or the young professional just starting to build wealth. They are competing more directly with the Robinhood app and SoFi ETFs against Fidelity ETFs. The user interface and the gamification elements are crucial here. SoFi has managed to create a brand that feels aspirational. It feels like a club. Fidelity IRAs and Fidelity brokerage accounts feel like